Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Ted Dixon, CEO and co-founder of IncResearch.ca, Canada's first online financial news and research service providing insider news and knowledge to investors. His website, CanadianInsider.com, home of the Canadian Insider Club. Welcome back to the show, Ted.
Jim, thanks for having me back, and thanks for everyone tuning in today.
Now, you said there's two economies at work, the G and D economy. Can you tell us what those are? And will G and D economy stocks both rally for the rest of the year?
Well, this is probably a good time to review our G versus D economy framework, which we introduced a year ago in the aftermath or during the arrival of the COVID-19 crisis in the spring of 2020. Now, what we looked at the time was the question, what will policymakers do in response to COVID-19? And we came to the conclusion that there were basically two options for policymakers, either to sort of do what they did in 2008, which was do some QE and throw in a little bit of stimulus, but not much, and basically put rates to zero. We thought that would be enough. That would put the economy into deflation and perhaps depression. That would be the D economy. Or they could go all in with stimulus, both fiscal and monetary, and try and stimulate some inflation, and that would be the G economy. Well, that's a framework that worked out pretty well because it became pretty clear quickly that policymakers adopted the G economy approach. And in fact, that benefited G economy stocks. And at the time, we were saying, this is going to be great for Canadian stocks, resource stocks, and any stocks that kind of were focused on inflation. And the Canadian Insider Index, which has a pretty high correlation with inflation expectations, it rallied between March 31st, 2020 and March 31st, 2021. It rallied 96%. So that's pretty good. All very good for the G economy. But where do we stand now? And after a very good run for the G economy, investors are probably rightly so questioning, well, what if, this stimulus, it wanes and the Fed's talking about tightening again, and maybe they're going to head to the D economy. And this is a risk that surfaced in the last Fed meeting. And I think you've got a lot of investors with cold feet right now going into the next Fed meeting wondering, oh no, are they going to keep tapering and keep talking about tightening, even when we have concerns about the Delta variant? And even before this Delta variant risk came along, there was still, there were some signs that the stimulus checks were starting, to kind of peter out in terms of their impact. So investors are starting to get a bit worried. We saw the gold-silver ratio pop up. This is one we've been talking about on the show here for the last couple of weeks. We were worried it would pop above 72. It did for a while. It closed below 72 last week. It's back up there today. But Jim, we're in this period in the summer where there's not a lot of liquidity, and when you've got liquidity-driven markets, which has been driven by stimulus, any kind of withdrawal of liquidity, either by policymakers or just people going on holiday, is going to be a bit of a headwind. So I wouldn't read too much into the volatility we're seeing here ahead of the Fed meeting. We'll see what the Fed does on Wednesday, and I do get tired of talking about what the Fed's going to do, but unfortunately, we're in a centrally planned market, and let's not kid ourselves. I mean, it's all about how policymakers respond. Jim, you and I may have differing views. We may have the same views on COVID-19 and the impact on markets. It doesn't really matter. What matters is how it impacts the Federal Reserve and their thinking, and Joe Biden and his government and their thinking. Are they going to do more stimulus because they're worried about, the impact of COVID? Do they think they can get through COVID and not do any more stimulus? That's really what matters, And I got to think that the Fed is going to have a hard time, pounding its chest going, we're going to taper, with the Delta variant kind of raging in the U.S. Now, when you look at how the Delta variant behaved in India, it had a huge spike, and it's, and now cases in India have come down quite a bit. You don't hear about that in the media because, that doesn't drive clicks onto these big media sites. They don't, we talked about it in our newsletter a couple of weeks ago that the cases in India have plummeted, but you don't see the big media companies talk about that because, it doesn't boost their advertising dollars. We're not an advertising-driven firm. Yes, we have some Google ads on CanadianInsider.com if you're not a member. If you're a member, you don't see any of those Google ads. We take them off if you pay, So, we're not really into the advertising part of the business, but, we can't just put our stuff up for free, because we have to pay for it. Like all the Canadian data that's on our site, we have to pay for it. It doesn't just magically appear. We have to pay for it. So, we do want people to be able to see, basic data. So we put some Google ads on. Well, in any event, the fact of the matter is that we're now in a situation where we've got some concerns about the coronavirus. Policymakers are likely going to be more dovish on the back of it. And the big question, though, I think, is what does the Biden administration do? Does this hasten the dollars that they're willing to push out the door to Americans to support the economy, or are we going to continue to see some gridlock here in Capitol Hill on infrastructure and more spending? So, these are the important points that I think we have to keep in mind. What will how will the Fed respond to the Delta variant, and how will the Biden administration respond? Not because, again, I have a personal view on whether they should or should not do in relation to COVID-19, but it's what will they do, because that will impact what kind of liquidity they push into the markets, how much. And if they decide to turn on the spigots again, that'll be great for G economy stocks. If they don't, well then we're tilting towards a D economy. And I think, those are the risks we're seeing with the bond market kind of rallying here a little bit, and also the gold silver ratio. But, I think there's another explanation too as to why we're seeing these D economy stocks rally. And D economy stocks would be those stocks that rise in sympathy with a rallying bond market, your growth stocks, your big tech growth stocks, your utility stocks, your defensive stocks. Those are some of your defensive stocks, not all of them. Some of them, basically the utilities, and I would say that the big tech are the prime D economy stocks. And you got a few others, special cases, which you write about in our reports. But to generalize, that's kind of what we're looking at. They're going to do well in a low bond rate environment. Yes, bonds will rally. Rates will stay low if investors are thinking the economy is in trouble. But there is another explanation as to why these D economy stocks could be rallying and why the bond market could be rallying. And it doesn't necessarily mean that there is a depression or a growth scare coming. It could just simply mean that investors believe the Fed will never let bond yields go much higher than they've already been. That 2% on the 10-year is basically the ceiling, and that even if inflation is ripping, which it is, inflation is ripping, yet I keep hearing in the market and on Twitter, and you only have to turn on the big TV network, the big business TV networks, and you don't even have to wait an hour before you've got somebody talking about deflation coming. The fact of the matter is that inflation is ripping, and that is the here and now. if you believe that it's going to roll over and it's all going to disappear in 12 months, fine, you may be right. But whether inflation rips or not, I think there is this underlying sense now developing that even if it's ripping, Fed will never let yields go much higher. If that is the case, then even these de-economy stocks could potentially do okay if you've got a ripping inflationary environment and you've got low bond yields. It would be a really bizarre investing environment. But Jim, when you get central planners in the mix, when you get them in charge, you get bizarre outcomes. So, we will see. I mean, that's one potential outcome that, we didn't think we would see the day when you would get both de-economy stocks and G-economy stocks potentially rallying. So long as you don't get a recession with real growth falling, I think you could see both the de-economy stocks and the G-economy stocks rallying here into the end of the year. We will see. That's not a prediction, but it's a scenario that I didn't think 12 months ago. I thought it would be either or. But look, the central planners in charge, any bizarre outcome is possible, and that could be a bizarre outcome. How sustainable, how long they can keep the game going is another question, because I think there is a big risk that we don't have real economic growth, and everybody's talking about inflation being transitory. Oh, is inflation transitory? Well, let me tell you something. Over the last 50 years, I just did the calculations. The U.S. official CPI has compounded at a rate of over 3.5% over 50 years. Okay, yes, there's periods where it was strong, there's periods it was weak, but inflation is not transitory. It's here. It's just a question of how strong. Okay? But growth, real growth, no one's talking about real growth. No one's talking right now about the possibility of a recession. Well, there is a possibility of a recession. And particularly if the Fed decides they're going to withdraw stimulus because they think they're so powerful that they can do that, I'm sorry, the Fed can never withdraw stimulus. The Fed can never raise rates. The Fed's never going to be able to taper. And if they try, well, they'll find out what happened. All you have to do is look at 2018 and saw what happened when they tried to do it then. If they try and do it again, well, then all bets are off. Then, I think you could see both D-economy stocks and G-economy stocks fall. So they could fall together, they could rise together, and of course there are situations where one could outperform the other. But it's really a bizarre time in markets, brought to you by our policymakers who believe that they are able to control things and manage outcomes so that everyone wins. Well, that's just a fallacy. There's always losers when you've got central planners in charge.
We'll have more with Ted Dixon right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Ted Dixon. Ted, insider sentiment is falling in the Canadian financial sector. What does it mean for investors?
Right. So that's one area that we've noticed some weakness in. Just to give you a contrast, we have seen a huge jump in insider sentiment in the mining area, which gives us confidence to believe that inflationary forces are here and not transitory. Yeah, and there is an inflationary impulse, at least in the mining area. So we've got some pretty high conviction. I mean, you just have to look at what copper's done. You've got all these hysterics about deflation coming, the bond market saying deflation, deflation, deflation. Well, somebody forgot to tell copper investors. They still seem to be willing to buy here over $4, well over $4. So, the mining area, based on our signals, is looking pretty good. But what kind of caught us by surprise is the financials. Surprise meaning because the financials, you know, Jim, it's just one of those sectors where in Canada, it's, it's just, there's this love affair with the financials. And, our signal's been downgraded to fair value from undervalued. So it's not like the end of the world or anything's coming. But we did notice some weakness there. And, we had a pretty good run with the Canadian financials earlier, along with the American financials, as interest rates were rising in the bond market, and that tailwind has come to an end, at least for now. That's more important, I think, in the U.S. market than the Canadian market. So what's going on in the Canadian market? Well, one of our stocks, which we'll be writing about for release on Wednesday, I believe it will be a financial. It did very well coming out of September, but now we've seen some insider selling and it's come off the boil here. It was one of these kind of challengers to the big banks. It's kind of losing some steam. And, I think the whole competitive environment in the Canadian financials is going to be pretty tough here for a while. So, I think that if you've had some money in the financials, what insiders are telling you is they're taking money off the table. You might want to take some money off the table and just reassess here what's happening. Are we heading for a recession, or are we going to keep the growth wheels going? If that's the case, there are probably other areas of the market that are better positioned for that. So yeah, the Canadian financials are just they're not flashing red. It's not like we've got them at overvalued, but they have been a favorite amongst Canadian investors, and right now, we put them as sort of a neutral bet right now at best. And yeah, if you've had some money in there, we would look at redeploying elsewhere in the market.
Ted, thank you so much for chatting with us.
Jim, thanks for having me back.
My guest has been Ted Dixon, CEO and co-founder of IncResearch.ca. If you have any questions for Ted, you can send them to info@HowStreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.